Hello again, everybody. Dr. Trussell here. We're in Chapter 5 now. We're talking about merchandising operations and the multi-step income statement. So we're just changing gears a little bit. Chapters 1 through 4, we always assumed that a company was a service company, and now we're going to deal with a merchandising company. So just as a preview, we're looking at the operations of a merchandising company in this chapter. How do you record purchases when you buy inventory, for example? How do you record sales? What's the income statement going to look like for a merchandising concern? And how do you evaluate profitability? So the difference between a service company and a merchandising company, and many times you think of a merchandiser as a retailer, in that they are selling merchandise, they're selling inventory. So they buy and sell goods as opposed to just providing a service. So that's the difference, and you see all these different companies they have listed in here as different kinds of retailers. All right, we have the wholesaler, which is a company who provides to many different retailers, like Office Depot here. And then, of course, you have the consumer. So we're looking at the category here primarily of a retailer, but also this would hold true for a wholesaler. Both of those are going to be considered merchandising companies in that they primarily sell merchandise as opposed to providing a service. So how we measure income is a little bit different. Remember, in a service company, it was just revenues minus expenses. So we're going to change it a little bit different now. In this one, we're going to say sales revenue minus cost of goods sold equals what we call gross profit, which is just the profit over and above what it cost you to buy the merchandise. Then we subtract out all our other expenses like rent and utilities, and then that gives you net income. So we have another step that we're adding in here, and that is the cost of goods sold. And just to compare a service company and a merchandising company, up here in the top we have a service company, and the service company basically just starts here, performs a service, typically on account. Account just means that the customer is going to pay later, and then they pay later and we receive the cash. But the merchandising company is another step involved in there. They buy the inventory, then they hold the inventory, then they sell the inventory on account, and then they collect the cash. So notice we add the extra steps here in this side over here, in that you're buying, holding, and selling inventory. The flow of cost in terms of, for a merchandising concern, is they have inventory at the beginning of the year. That's the goods and items they hold for sale. Like if you're looking at a company like Walmart, they would have all of the clothes and food and everything else at the beginning of the period. Then they would buy stuff during the periods, and that's what they'd have available for sale. And the goods that they have available, they either sell it, which we have cost of goods sold, or they hold it. They still have it at the end, which is ending inventory. Cost of goods sold over here, that goes on the income statement, where ending inventory is an asset. So cost of goods sold is an expense on the income statement, where ending inventory is an asset on the balance sheet. And the companies use what's called either a perpetual inventory system or a periodic, and we'll talk about that. That's how you keep track of inventory. Under perpetual system, a company, this is a method of keeping track of your inventory. It's basically a way to follow or account for or keep track of your inventory. And each item that they buy and sell, is right here. Maintain detailed records of the cost of each inventory purchase and sale. So you know every time something purchased, every time something is sold. And the records continuously show inventory that should be on hand. So when you buy something, you know that you have it. When you sell it, you know that you have. In other words, they would have accounting records, a computer system that would show how many units, how many shirts does Walmart have at any one point in time. And then they determine cost of goods sold, how much a sale costs each time we have a sale. A periodic system does not keep detailed records. And the only way that you can figure out your cost of goods sold is by a count at the end of the period. They call that a physical inventory count. And so then to get cost of goods sold, you're going to have to compute it. So it's a little bit different. You have to calculate it versus just being in your records. So you take your beginning inventory and then you add in your purchases, gives you what you have available to sell. Then you subtract your ending inventory, and that's how you come up with cost of goods sold. A perpetual inventory system, for example, if you go into a store and they scan it with a scanner, what are they doing? They're not only are they updating the what you owe them, but they're also updating the records that they're taking one item out of inventory. So it is used with high unit value items, although that's changing because of the cost of the equipment is coming down, the computer equipment and software. It shows the quantity and cost of inventory that should be on hand anytime, and thus it provides better control over the inventories than a periodic system. So we're going to talk about how you record a purchase of merchandise or a purchase of inventory. And we're going to talk about it from the perspective of a perpetual inventory system. You see it down here at the bottom of the page. We're using a perpetual system. So you can buy inventory on cash or account. That is, you have an open account from your supplier and you buy on credit. And you normally record the inventory purchase when the goods are received from the seller. A purchase invoice should support each sale. And here's an example over here of a purchase invoice. Just an invoice that shows your supplier will give this to you to shows how much you purchased of each one. So you'd have the quantity and the price and then the total amount. And then you add everything that you bought together to give you the total amount that you owe them. And that's called a purchase invoice. So here's an illustration. Salk Stereo, the buyer, uses as a purchase invoice the sales invoice prepared by PW Audio Supply, the seller. Prepare the journal entry for Salk Stereo for the invoice from PW Auto Supply. In other words, we're looking at two sides of the transaction. PW Auto Supply is the supplier, and then they would prepare a sales invoice, but from the purchaser's perspective, that would be considered a purchase invoice. So what do we do? What does the purchaser do on May 4th? They debit inventory and credit accounts payable because they bought this on account. So inventory is an asset increasing, accounts payable is a liability increasing. What about freight? It depends on who pays the freight costs, how you record it. And we have two things that are called FOB shipping point, which you see right here, and FOB destination, which you see down here. It tells you when the title passes and who pays the freight costs. So the seller over here is shipping to the buyer over here, and if it's FOB shipping point, it means as soon as it leaves the seller's hands and is loaded onto the truck or whoever, UPS, whatever it is, the buyer pays the freight costs and then they'll get the title, and so the ownership transfers at that point. FOB destination, down the bottom picture, the ownership passes to the buyer when it's received by the buyer. So that's normally the seller paying the freight costs, and then the title doesn't transfer to the buyer until it received by the buyer. It's a big deal with things like insurance and things like that. Okay, and then you'll see down the bottom, freight costs incurred by the seller are an operating expense. Here's an illustration. Assume upon delivery of the goods on May 6th, Sauk Stereo pays Public Freight Company $150 for the freight charges or the shipping charges. So what do they do? Well, the $150 is considered part of the cost of the inventory. So it is put into the inventory. But from the perspective of the seller, which is down the bottom of the slide, the seller records, assuming that they would have paid it, they would have what's called freight out, which is an expense. So this is assuming that the buyer pays at the top here, and the bottom assuming that the seller pays. So the top is the buyer, bottom is the seller. Obviously they both won't, they both don't pay, so it's one or the other. What about purchase returns? If you're dissatisfied and you decide to return it, maybe it's damaged, defective, whatever reason, you buy a shirt, it doesn't fit, you buy shoes, they're too wide, whatever. And so we have a purchase return, which is you're just returning it to get credit or get a cash refund, or an allowance, which means you might get a discount. Maybe you find out, I remember once I bought a couch, and it turns out there was a little rip in the back, and the guy said, well, you can return it, or I can just give you $100 off the price. And it was in a spot we really couldn't see it, so I took the $100. That would be called a purchase allowance. As an illustration, assume Sauk Stereo, now this is the purchaser right now, return goods costing $300 to the supplier, PW Audio. So they're going to reduce what they owe them, and it's coming out of their inventory. So you're kind of just flipping around the original entry that you made. In a perpetual inventory system, a return of defective merchandise by a purchaser is recorded by crediting what? Well, we just did that entry, and you're going to credit inventory because you're reducing the amount of inventory that you have. A purchase discount is what happens when you buy on account. You use credit from your supplier, and they give you a discount for paying early. And so what happens is the purchaser saves money because you get a discount, and the seller shortens the operating cycle because they get their cash earlier. So it kind of both sides win. For example, you'll see what are called the purchase terms, and you'll see various things like the first one, 210 N30, 110 EOM, N10 EOM. What do these things mean? In the first one, the first number there is a discount. The second number is the discount period, and the third item is when the balance is due. So 210 N30 means 2% discount if paid within 10 days. Otherwise, the net amount is due within 30 days. What does this 110 EOM mean? 1% discount if paid within the first 10 days of the next month. And then N10 EOM, net amount due within the first 10 days of the next month. As an illustration, assume Sauk Stereo pays the balance due of $3,500, which remember that was the original $3,800 less the return that they had of $300 on May 14th. And that was 10 days after they bought it. So that's the last day of the discount period. How would they record the payment? Well, first of all, you have to reduce the accounts payable by the full amount because that's what you owe them. However, the amount of cash is going to be less the discount. So the discount is computed as 2% of what you owe them. And then we have the cash. And why reducing inventory? Because you're in essence reducing the cost of the inventory because you paid in essence less for the inventory. If they did not take the discount and made the full payment, the journal entry would be this. A lot simpler. They just pay the full amount, the $3,500 in cash. Should the discounts be taken when offered? A lot of people think, well, it's only 2%. Why would I do that? If I can wait 30 days, I'm keeping my money for 20 longer days than if I took the discount on the 10th day. So I can take the discount on the 10th day or pay on the 30th day. A lot of people think, just hold the money. Well, let's just show you what kind of discount you would get. Well, we know that the discount is $70. We just figured that out. If we, instead of doing that, we held on to it for those final 20 days and we kept that and invested it at 10%, which is pretty high for 20 days, you would get $19.18, and therefore you would have a big savings of $50.82. It almost always works out where it's best to take the discount. And what's the percentage rate that you'd pay if you don't take the discount? Well, if you look at this calculation down here, it turns out that the discount, the percentage interest that you're making or saving, if you will, is that 36.5%. So here's a summary of the purchasing transaction. You bought the inventory on the 4th. That was $3,800. On the 6th, you paid for the freight. That goes into your inventory account. Both of those increasing inventory with debits. And then on the 8th, you returned, so you had $300 and you had to reduce your inventory. And then you took the cash discount for paying early on the 14th. And so what you owe, the balance is $35.80. Not what you owe, sorry, not what you owe. What you have in inventory. Inventory is the asset account. What you own in your inventory. That's how it would be valued. So let's look at the other side. We just looked at the purchasing side. Let's look at the other side. In other words, the supplier, they are the seller. We looked at it from the purchase perspective. And again, you can sell for cash or an account, and we're going to record sales revenue, which is very much like service revenue, when when this performance obligation is satisfied, when you ship the goods and there was nothing else you had to do for your customer. And so the performance obligation is satisfied when the goods are transferred from the seller to the buyer. And then we should have a sales invoice, which we've already seen. The journal entries, there are two to record a sale. We have to record the sale at the selling price, and we have to record the cost at whatever it costs us to buy the inventory. And let's see an example. Same example, exact same example. We sold the merchandise. Remember, Salk Stereo bought it. PW. Now we're looking at from the perspective of the supplier. They record the sale of $3,800. Assume that it cost them $2,400 to buy it from the manufacturer. So we would have, first of all, to record the sale. We have accounts receivable and sales revenue. And then we have to record the cost of the sale of the $2,400. That's recorded as cost of goods sold. Remember, that's an expense, and inventory is an asset. And then the sales and returns are going to look very, very similar to the purchase returns on allowances. It's basically just a flip side. So if same thing, if they had recorded if the SOC returned $300 worth of merchandise and it cost $140, assuming the goods were not defective, they're just returning them because they didn't like them for one reason or another, you're going to return debit sales returns and allowances, which is what we call a contra account to the sales account, and reduce our accounts receivable, but you have to put the inventory back on your books. So in essence, you're kind of flipping around that account that you originally recorded. Assume the goods were defective, it's a little bit different. The first entry looks the same, but if the goods were defective and had a scrap value, in other words, they're not completely worthless, they're worth something but not the original $140, then you make the same first entry, but the second entry you would record at the lower value. So here's a review question. The cost of goods sold is determined and recorded each time a sale occurs in which method? Well, only the perpetual system. In a periodic system, you do not record the cost of goods sold until the end of the period when you count the inventory. And recording a sales discount is kind of just opposite of recording a purchase discount. In other words, the purchaser got a discount for paying early, and then the seller is recording the discount that they offered. So assume the same kind of thing that we had before. They paid during the discount period. Now we're on the seller side, and so we're going to have the same, in essence, same journal entry that we had, but kind of upside down, if you will. Instead of accounts payable, we have accounts receivable. And we have created an account called sales discount here to record the amount of discount that you received. Now, a single step income statement is similar to the one that you learned in the previous chapter. We just take revenues minus expenses to get our net income. And we might use that if they don't have a gross profit. It's simple and easy to read, but most companies, most merchandise companies do not use this method, but some do. So it's very straightforward, just like we've done in previous classes. Take the revenues, subtract out all of your expenses, and you get net income or net loss. The multi-step income statement. This is going to be new in this chapter. This is probably the biggest part of the chapter. Now, what we're going to do is, instead of revenues minus expense, just one step, we're going to have multi-steps or 3 steps. We're going to have a gross profit, income from operations, and net income. So it looks like this. We have sales minus cost of goods sold equals gross profit. Then we subtract out our operating expenses to get income from operations. Then we have other revenues, other expenses to get our net income. So multi-steps in this one. Breaking this down a little more, we have net sales, which is sales minus returns and allowances and minus discounts. Then we have gross profit, which is net sales minus cost of goods sold, gives you gross profit. Excuse me. Then we have operating expenses, which all the expenses of operating the company. We have non-operating activities, which would be activities, revenues, and expenses not related to operating, the day-to-day operating of the company. That include interest revenue, dividends, rent, etc. And then we have net income. The multi-step income statement for a merchandiser shows each of the following features except what? Well, we just talked about all of these. You've seen gross profit, cost of goods sold, sales revenue, but you have not seen investing activities. That goes on a statement of cash flows. That's not on the income statement. Determining costs under periodic system. Under periodic system, we're not keeping track day to day, sale by sale of our inventory. So you buy something, and they're not scanning it into the computer system, they're just maybe typing up the sale. And the inventory can only be determined by a physical count, and the cost of goods sold is not determined till the end of the period because you're not keeping track of the inventory. So under a periodic system, since you don't have your cost of goods sold kept day by day, you have to actually compute it. And so therefore you have to count ending inventory. So this number right here you're not going to have until you get to the end of the period and go out and count and price out your inventory. And so that's why you need this formula, if you will, to come up and compute cost of goods sold, because you will not have it on your records. So let's do an example. Aerosmith Company's accounting records show the following year end, December 31st, 2014. They give you all this information, and then it says, assuming that Aerosmith Company uses the periodic system, compute cost of goods purchased and cost of goods sold. All right, so we start with beginning inventory. You add in purchases and take out purchase returns and allowances, those things you sent back, any discounts that you took, and then add in the freight that you paid. That's going to give you goods available for sale. Then you subtract out your ending inventory. You have to go out then and count your ending inventory, and that's going to give you your cost of goods sold. Let's now talk about evaluating profitability. And this, in other words, how to interpret the profitability. One thing is called the gross profit rate. And basically the idea of the gross profit rate is to figure out what percentage your gross profit is compared to sales. It is computed by taking the gross profit and dividing by sales. So here's REI, which if you don't know REI, it is kind of a high level sporting goods store. And then of course you know Dick's, we have those around here, which is sort of a mid-range sporting goods store. So if you just you're taking their gross profit, which is in the numerator, divided by net sales, and what this says, 43.9, almost 44% is their gross profit. That is, for every dollar of sale, 44 cents of that is gross profit. Now compare that to Dick's, which is just under 30%, and the industry average is 34%. Why? The question is, why does REI's gross profit rate differ so much from that of Dick's Sporting Goods and the industry average? In other words, why is it so much better? And probably because they're dealing with high-end stuff that has a little bit better profit margin in it. However, if you look at the bottom line number, which is the profit margin, it's different than the gross profit rate. So the gross profit rate measures the margin which the selling price exceeds the cost of goods sold. But the profit margin, the extent by which the selling price covers all expenses, including cost of goods sold. So instead of gross profit over sales, it's net income over sales. Net income over sales. Now if you compare REI to Dick's, now it's a little different story. Notice that REI is about 2%, but Dick's is 3.7% and the industry average is 5.1%. Now why? So REI has a higher gross profit rate but lower profit margin. Why would that be? Their expenses are higher. That is, REI's operating expenses are higher than Dick's. But we can't ignore cash. We have something called our earnings, our quality of earnings ratio, which we take, here's the formula, take net cash provided by operating activities. That comes from your statement of cash flows. That's how much cash you got from operating the company versus net income, which is how much profit you got from operating the company. And like it says here, if that is significantly less than 1, that means they're using more aggressive accounting techniques to accelerate your income recognition. You would say that their quality of earnings is not very high. And if it's greater than 1, it suggests very conservative accounting techniques cause it to delay recognition of income. So you would say it has a higher quality of earnings. So higher the number, the better. We'll talk a little bit about recording merchandise transactions using the periodic system as opposed to perpetual system. So we record revenues when sales are made, just like perpetual, but we do not record cost of goods sold the date of sale like we did under the perpetual system. And in order to figure out cost of goods sold, you have to take a physical inventory count. You have to go out and count your inventory. And so that tells you how much merchandise is on hand. And then of course, we saw that formula. It tells you the cost of merchandise sold as well. We record purchases in the purchases account as opposed to inventory, and purchase returns and allowances, purchase discounts, and freight costs are in separate accounts rather than all coming out of the inventory account. Here's just an example, that same example that we did earlier, which is right here in the middle in the blue numbers. Those are the transactions we recorded earlier under the perpetual system. And then over on the right here is the same journal entries under the periodic system. And some of the big differences is the fact that you use inventory versus purchases, inventory versus freight in, inventory versus purchase returns and allowances, inventory versus purchase discounts. So it's a lot of it is inventory is always used for perpetual inventory. That's because you're always updating your inventory records. So that's why it's different. And then on the selling side, that was the purchasing side. The selling side, perpetual system, the first entry exactly the same, right? These entries are the same. The biggest difference though is the second entry. We don't need a entry for cost of goods sold under the periodic system. And then after that, it's fairly similar, but again, we have no entry when you have a return. Now let's look at IFRS. Remember, these are the international standards, and they can use perpetual or periodic system under both GAAP and IFRS. And IFRS defines inventory slightly different, but it's very, very similar. And then another big difference is under US GAAP, companies generally classify income statement by function. Function will be things like administrative costs, distribution costs, manufacturing costs. But under IFRS, they can use function or nature. Nature is the descriptions of things, salaries, depreciation, utilities, as opposed to administration, distribution, etc. Also, under GAAP, we allow single step or multi-step. It is either one's acceptable under GAAP. IFRS doesn't mention either one of them, meaning that it's kind of up in the air how they do that, although it's very typical they use a single step method. And then IFRS allows a revaluation of land, building, and tangible assets. That is, they can write them up or down to the whatever the fair value is. And similar to GAAP, comprehensive income includes what they call unrealized gains and losses. That's what they do when they write up or write down their assets to fair value. And another difference is IFRS requires 2 years of income statement be presented in the annual report, where GAAP requires 3. Which of the following would not be a line item of company reporting by function? Okay, function, all of these: administrative, manufacturing, distribution, but this is by nature, the nature of the expense. Well, that's the end of chapter 5, and that is dealing with the income statement, primarily dealing with the income statement for a merchandising concern. I'll talk to you soon.